Investing like Warren Buffett is no easy undertaking, but you need not invest like Warren Buffett. Instead, pay attention to his guidance, which is applicable to both novice and seasoned investors equally. There is a wide variety of advice available from Warren Buffett, ranging from broad counsel to specific themes. If you are interested in gaining additional knowledge, be sure to continue watching as we will be discussing 8 things Warren Buffett says not to do when investing and growing your wealth. Don't forget that this video is for information and entertainment purposes only, and not to be considered in any way as financial advice. Don't hold too much cash. Having money available for unexpected expenses is always a smart idea. However, having an excessive amount of cash on hand can impede the expansion of your net worth. Those with more time to invest stand to gain the most from the stock market, making it crucial that they start early. A survey conducted by a financial service company found that investors in their 20s hold more than 28% of their money in cash. This finding suggests that investors in this age group may be too risk averse. That's the highest percentage of any demographic group, and it's exceeded only by retirees in their 80s and 90s. If you maintain a significant portion of your money in cash, you won't be able to keep up with inflation, which means that your purchasing power will decrease, meaning things will get increasingly expensive over time. You want to put your money to work. Don't time market conditions. In most cases, the cost of waiting for the ideal time to buy or sell stocks outweighs the actual return. It is easy to look back at past performance and say that you understand the stock's movement. To put that to use in predicting the future price movements of any particular stock is foolish. There are simply too many unpredictable variables. Since nobody really knows what a stock is going to do in the short term, Warren Buffett would say that the best course of action for the vast majority of us is to avoid market timing altogether. There is a common misconception that market timing, buy low, sell high, is a superior strategy to the buy and hold approach, but typical long-term market performance suggests otherwise. Investors like us should not take the past performance data and the countless Wall Street opinions on market timing as evidence that they can invest their money and get superior results. Don't worry about diversification. Indeed, financial experts such as investment advisors and portfolio strategists have devoted a significant amount of time and energy to researching and developing the most effective methods for mitigating the dangers associated with investing. They have all arrived at the same conclusion, which is that the most effective approach to achieve this goal is to spread holdings over a variety of asset classes, such as stocks, bonds, gold, hedge funds, and other investment strategies designed to even out returns. Diversification has the effect of lowering the level of volatility. It is true that diversification can help smooth out investment returns, but the decision to diversify is more of a psychological one than an investment decision. As a consequence of this, asset allocation diversity does not improve the performance of investments. Rather, it has the opposite effect. So why do professional portfolio managers and financial advisors diversify their clients' holdings into bonds and other low-risk assets in order to reduce the portfolio's level of volatility? The answer is fear. The single greatest fear of both novice and experienced investors is being caught in a major stock market decline of at least 40%. So they play it safe. Warren Buffett takes a different approach, which, although very simple, has proven very effective for his company, Berkshire Hathaway. Learn how to analyze businesses and how to value businesses. Then, simply invest in the ones you like. You don't need that many to be a successful investor. Don't confuse volatility with risk. Volatility is not an accurate measurement of risk, and the problem is that those who have written and taught about risk are not aware of how risk should be measured. Although it is a reliable indicator of past volatility, this metric is not useful for gauging the risk associated with future investments. That risk is synonymous with volatility, and that there is a one-to-one relationship between risk and potential profits, two of the most common misconceptions regarding investments. This thinking is both careless and potentially harmful. The measure that is frequently used, called beta, is a comparison between the movement of risk, also known as volatility, of a particular stock and an index or a benchmark. However, the statistical measure does not take into account any fresh facts or events that have occurred recently. Beta does not work during periods of short-term volatility for long-term investors, since it is unreliable and contains very little information that may be used to foresee the related risks in the future. Investing in the financial market comes with inherent chance of experiencing periods of extreme volatility. This isn't risk. Risk refers to the probability of incurring a loss that cannot be recovered on investments made in financial markets. This can come from the kind of businesses you may be invested in by the simple economics of that type of business. Risk also comes from not knowing what you're doing. But if you invest in a business at a price you like, and if you understand the economics of the business and the people running it, then you don't run any real risk at all. For short-term investors, volatility can play a big role in their profits, good or bad. But like Warren Buffett, long-term investors in good businesses tend to understand risk and pay less attention to volatility. Even Warren Buffett, one of the wealthiest people in the world, has had difficult times in his life. It wasn't all rainbows and sunshines. His guidance, which is what we will be talking about today, is one that was gained through experience, and is something that absolutely everyone needs if they want to be successful. If you want to learn more, make sure to keep watching. Don't be swayed by the crowd. You don't need to be a genius to be a successful investor. What you do need is the right temperament. You need a personality that is not swayed just because the crowd is going a certain way. You should not consider yourself correct just because everybody agrees with you. Conversely, and perhaps more challenging, is to not assume you are wrong just because everyone is against you. You are right because you have done your research and your facts and reasoning are right. On the contrary, a herd instinctive investor is one who makes investing decisions based almost entirely on the fact that many other investors are doing the same. Large irrational market movements such as widespread buy or sell-offs have often been sparked by herd psychology rather than any underlying business or market fundamentals. In the long run, this has been a major factor in the formation of asset bubbles in the global financial markets. This herd psychology puts the investor herd in a state of panic due to the news and rumors around the next major company or the latest breaking news. The dot-com bubble was classically herd psychology. Remember when websites like etoys.com and cosmo.com claimed to ship you anything from movies to groceries right to your front door? These ventures received hundreds of millions of dollars in funding before collapsing as the bubble burst. Many people put their money into them because they were popular at the time and then lost it. It was all just hype. They were not able to make rational investing judgments due to the fervor of the crowd. Don't ignore yourself. This isn't complicated. Stay healthy, eat the right food, exercise regularly. A fit and healthy body fosters a fit and healthy mindset. There is a common theme in almost all self-improvement literature, which is this: not everybody who eats right and regularly works out becomes successful millionaire business owners, but nearly 100% of successful millionaire business owners eat right and regularly work out. Furthermore, put some focus on developing yourself and learn new skills that can help you. For example, communication skills are often overlooked as a skill set in inspiring entrepreneurs. Going to graduate schools and business schools teach all kinds of great technical skills, but perhaps the most valuable of all skills is to be able to get along with people. You need people to succeed. Don't gamble. As Warren Buffett would say, gambling is a tax on the ignorant. The need for people to gamble is enormous, and with the advent of online trading, gambling on the stock market got a whole lot easier. If you are ignorant of the companies that you invest in, then this is similar to gambling. There really is no substitute for proper analysis of the businesses you are interested in and having a long-term outlook in them. But even a great company's stock price will still bounce around like a roller coaster over the short term. So have the confidence that you have done the work to select the right business and you will find stability in the long term. If you really like the emotional roller coasters, then day trading may be for you. Don't wait for the right time. The timing of your buy or sell in the long run is not something a savvy investor should worry about. If you have identified a great company and you intend to hold it and accumulate it for many years, then just buy it. In the long run, waiting for a price drop before buying will make very little difference, and your time trying to figure out timing is much better spent on due diligence of the business you are looking to buy. Nobody is able to consistently hit the peaks and troughs of the market fluctuations. So accumulating shares of good businesses over time has worked very well for Warren Buffett. Don't be too overwhelmed by the things in this video. The process of making a lot of money through investing is not simple. But hopefully, some of these tips from one of the most successful Wall Street investors ever should keep you on the right track. If you want to learn more about keeping a wealthy mindset, click the videos on the screen. Thanks for watching, and we will see you in the next one. This video is for information and entertainment purposes only. The information contained in this video is not to be considered in any way as financial advice. Always check with a professional before making any investing or financial decisions. Your investments and financial decisions are your sole responsibility. Thanks again for watching.